Hello, and thanks so much for watching Proactive New York. I'm Christine Corrado. With me right now is Nick Kovacevich, CEO at KushCo Holdings. Along with him is Stephen Christoffersen, CFO. Good to have you both. How are you?
Doing well. Thanks for having us.
Thanks for having us.
Of course. Happy New Year to you both. The company reported fiscal 2021 first quarter earnings this week. Nick, could you take us through some of the highlights here?
Yeah, so we were very pleased with our results for fiscal Q1. Keep in mind, we're coming off of just a phenomenal Q4 where we crossed into profitability from an adjusted EBITDA standpoint for the first time in 3 years. And we were very pleased to be able to follow that up with another quarter of positive adjusted EBITDA to the tune of about $500,000. And Q1 is typically light for us, just coming off of the summer months, which is our Q4. It's a very strong finish to the fiscal year. And there's less selling days in Q1, and we still managed growth. We were up 1%. And that was despite some temporary headwinds that our company's facing, but also the global economy is facing in terms of freight issues with COVID-19. The ports are extremely backed up right now. So we actually had some revenue shift into December, which is our Q2, which led to a record December number as well. So all signs are very positive, being up despite the headwinds, starting Q2 off on a great foot with a record December. And then going a layer deeper, we were able to sign another long-term supply agreement with one of the largest cannabis operators in North America, one of the top MSOs. So we feel great about that. And we're rolling out our stainless steel tanks, which we believe we're the only ones in the market with these premium vessels to house butane for cannabis extractors. And we've signed now over 20 contracts as we start to roll those out. And we have an internal goal of receiving over 100 signed contracts for these stainless steel tanks by the end of the fiscal year. So we're well on track to accomplish that. And then the last takeaway was continued execution on the cost cutting. As you know, that's been a plan for us since last year, where we really focused on managing our cash. And we were pleased to report our lowest cash SG&A in recent years at $6.5 million, which was down even 10% from where we were just a quarter ago in fiscal Q4 of 2020.
Yeah, it's great to see this growth, really, despite what happened in 2020. Stephen, can you go a bit more in depth into how you shrunk losses here and reduced SG&A spending?
Sure. So we kind of set out on the plan earlier in 2020. We announced our 2020 strategic plan where we rationalized our facility footprint as well as overall headcount. We're about 75% of the way through this cost-cutting initiative. We were able to drop cash SG&A, as Nick mentioned, $6.5 million last quarter compared to $15.5 million this quarter a year ago. We announced that we're going to be closing an additional 3 facilities over the coming quarters and stripping another $1 to $1.5 million out of the business. And so it's all part of the plan that we kind of put in place, set in motion in April, March timeframe. And we're feeling really good about it. And we have some really nice visibility in the overall cost structure of this business going forward.
Thanks very much, Stephen. And back to you, Nick. You mentioned those December sales. How does this factor into revenue guidance and outlook for the rest of the year? You did raise your revenue guidance.
Yeah, with the strong December, we're now 4 months into the year, over $40 million in sales. And if we would have stayed completely flat, we would have still been able to beat the low end of our previous guidance range. So we felt it prudent to raise that range by 10 million. So we're now guiding to 130 to 160 million for the fiscal year. We feel very good, especially about the midpoint of that range, which is 145 million. That's where most of the analysts are going to have us pegged. So we're feeling very good about that. There's also upside. As you know, there's been a lot of positive activity on the cannabis legislation front, both at the federal level, but more importantly for our business at the state level. We saw New Jersey, Arizona, Montana, and South Dakota all pass adult use cannabis on November 3rd. And now we have New York announcing that they're going to roll out adult use cannabis here very soon. So there's significant upside, which is why we did the higher end of our range up to 160, because who knows what the future is going to hold. And if these things move fast, that represents a boom in sales for KushCo. we're already working with these clients positioned in New Jersey, positioned in Arizona, positioned in New York. And so if those spigots turn on, that's just more volume coming through our pipeline. So we're in a really good spot to capitalize on the growth of the industry. And we're at a really significant valuation decrease from where a lot of the players are. So people now are looking at us as a value play in the industry. So it's going to be an exciting year for us. We're very well positioned. We think we can continue to grow this business, but most importantly, do it in a profitable fashion, which is exactly what our investors are looking for.
Looking forward to it. Nick, Stephen, thanks so much.